and welcome to this webinar, Passive Investing, the best strategy for new investors to create long-term wealth, brought to you in association with Finity. So today we're going to talk about how passive products can help investors, especially the new investors, create long-term wealth, achieve all of their goals. What are the intricacies of passive products? How do they compare with active funds? What are the taxation? What is the trends that we're seeing in other countries? So all of that will be answered in this webinar. Joining in, we have Abhilash Joseph, who's a business head at Finity, and Shweta Jain, founder of Investorgraphy. So Abhilash and Shweta, thank you very much for joining in. I think there's rarely a person now who wouldn't know what passive funds are, but yet there is a lot of confusion, because on the face of it, you may know somewhere that there is this product, new kind of, scheme which has come. So let's first start by demystifying what passive products really are, right? So Abhilash, let me ask you, is there a growing sense of, people wanting to know about passive products? How are they being explained? And, what is, say, the appetite within investors for passive products?
Thanks so much for, having us here. I think over the last few years, passive products have gained in popularity, right? And there are two main passive products that are out there. One is index fund, the other one is ETF. And in the last 2 to 3 years or so, for various factors which we will explore in this conversation, passive funds have gained in popularity. Especially with a lot of financial influencers and financial content out there, people are more and more talking about passive products. And as a result, the interest among retail investors for passive products have gone up massively. So passive is a trend and a movement that we are seeing that is growing day by day in India. This trend picked up a couple of decades back, 2 or 3 decades back in the West. But in India, now we are seeing massive growth in passives. And this is something that we see or we expect that will continue to pick up as we move forward.
Okay. Shweta, what has been your experience with passive products, especially with retail investors, right? And also first-time investors. Is there a growing acceptance? Is the concept, are you able to get the concept across?
I think retail investors are even more welcoming towards passive funds for the first main reason being, they're cost effective, right? They're very less cost versus an actively managed fund. So where an actively managed fund could be 1.5% to 2%, here you can have a passive fund which is 0.3%. So India as an economy, as retail investors, right, are very cost conscious. So when it comes to just this one difference, I think investors are very open to passive. In fact, the first discussion these days is, are you going to recommend a passive fund to me, or are you going to recommend an active? And I better have data to back up for active funds if I'm recommending those. Passive funds, they're more saying, okay, we know this is going to track an index, and we're going to get similar returns and less costly. So I think investors are getting smarter by the day. They're looking at more and more data, which is easily available. Also, with the influx of more and more products, I think the whole story has changed, where investors, we needed to sort of talk to and explain to investors about passive, saying, this is going to track an index. And investors would earlier want saying, how much more extra can I make? Can I beat the benchmark? Today, that is not there. That emotion is not there. Today, the emotion is, keep the cost low. I'm okay hugging the benchmark and getting similar returns.
Yeah, we don't want a capital loss, basically. Okay, so basically now passive products in India as a market has grown to what, 4.2 lakh crores thereabouts. It's about 11-12% of the total assets which have been deployed by the mutual fund industry. Abhilash, but there are a lot of new mutual funds now being launched, yet to be launched, who say that they will only have passive products. You think that is the way of the future? That even for investors, that purely passive products could work?
Yep. So I think when it comes to building a portfolio for an investor, there definitely is space for active investments as well. But like Shweta mentioned, there are lots of new products that are coming in today across the board, across categories, equity, debt, gold. Recently, very soon the government is going to launch. We are going to launch silver exchange traded funds as well. So across the board, across asset classes, there are passive products available today. If an investor wants, one can say that a complete portfolio can be built purely with passive products. But that said, I think there is still scope for actively managed funds in an investor's portfolio. For example, small cap funds. There still are gaps there, information asymmetry that could happen, where a fund manager's expertise and stock picking abilities could definitely come to play. But that said, when it comes to building a portfolio, if one wants, they can build a portfolio that matches an index purely with passive funds alone.
Exactly. And Shweta, now with the market rally becoming more broad-based, right, which basically means that more stocks are doing well. There is a lot of scope for active funds, right? It was all very well when the actively managed funds weren't able to deliver alpha. But the expectation is that, at least for the near term, in a growing economy like India, alpha can be generated. There is scope provided, of course, you have found the fund. So therefore, does this active passive mix work for the Indian retail investor, or is there a time coming when people will be like, a 3 ETF or a 5 ETF portfolio is going to work this fine for me?
I think just passive investing is not going to work, at least not for the Indian investor. And I'll tell you a couple of reasons. One, definitely there's scope for alpha to be generated, even in large cap funds, not just mid and small. I completely agree with Abhilash saying, small cap, there's a huge gap, and that definitely can be filled with active funds. Having said that, in India, everybody is a fund manager, right? So we see more and more investors, retail investors, wanting to have their own direct equity stock portfolio, which we've seen in the last 1.5 years increase also. So when it comes to actively managing, they would want to have a separate portfolio which is actively managed, and of course, maybe the core portfolio could be more passive, but that allure of alpha is definitely there. So we're not just cost conscious. We're also a little bit greedy when it comes to generating that extra return. And one thing we definitely want is bragging rights. So when our portfolio does well, whether it's a mutual fund or whether it's an equity portfolio, Indians love to brag, and they want that bragging right. So I think just for that one right, we can say that they want a combination of active and passive, and active is not sort of going anywhere.
Yeah, I also take that point because, the market is not yet saturated, right? At least that's what we're told. But Abhilash, coming to you, then what are the kinds of products, right? I mean, we know that there is an index fund and there's an ETF. So that is the broad differentiation, right? But now we have all of these smart beta funds. There is a lot of innovation happening because, on the active side now, pretty much the funds are straight-jacketed, right? There is a strict SEBI definition for every kind of fund and how to run it. So whatever innovation now happens is going to happen only on the passive side. So therefore, it's again becoming a jungle, right? How do you select the passive fund?
Yeah, I mean, see, good question, Sumaira. So this is one question that we get asked often. How within there are lots of index funds within, let's say, a Nifty 50 category. There are multiple index funds that are out there floated by different asset management companies. Our answer to that is one. One should think about the pedigree of the asset management company. That is one very easy way of looking at, or one of the ways of selecting a fund. Number two, there are other components to, let's say, an index fund, such as an expense ratio, which is the cost that Shweta mentioned. Typically, an actively managed fund tends to have an expense ratio of upwards of 1.5% up till 2.5%. And a passively managed fund, an index fund, could have an expense ratio of about, on average, about 0.3%, and as low as 0.05%. And costs tend to be a very, very significant aspect of how an investor chooses a fund. So the expense ratio is another aspect, and there is another aspect to an index fund called the tracking error, which essentially talks about how effectively or how efficiently the particular fund tracks or mimics or replicates the index's returns. Those are two things. And the other thing is, like you just mentioned, there is a lot of innovation that is happening out there when it comes to passives. Very soon, one of the asset management companies is going to come out with an electric vehicle and smart vehicle fund. So these are exciting times. There is a lot of innovation that is happening out there. So such funds, people can participate in the innovation that is happening in the technology world, not just in India and outside. Right, there are lots of international funds that are out there, international passive funds, international ETFs, and index funds. With that, till about 5 years back, it was very difficult for an average retail investor in India to participate in innovations that are happening in developed markets, especially in the technology space. Like, for example, if I want to invest in Google, if I wanted to invest in Microsoft, if I wanted to invest in Amazon, it was close to impossible. Of course, HNIs have their way of doing this, and it was extremely costly. But today, that is possible for any investor. Even if you want to invest 1,000 rupees, 500 rupees a month, you can still participate in these growth stories, these innovations that are happening out there. So a lot of things happening in the passive space. And another thing that is coming out is a blockchain based index fund is coming out very soon. So these are possibilities that are available today in India only through passive. So in that way, there's a lot to look forward to, and this space is becoming hotter and exciting, more exciting by the day.
Yeah, but I thought investing was supposed to be boring, right? At least good investing. But by the way, since we've spoken so much on cost, let me just tell you that India is the only country in the world which has some of the cheapest, most actively managed funds in the world, right? So we have a lot of these NFOs which have come out, and the direct plans are actually, competing with index funds, if not cheaper. But Shweta, on this whole point of innovation in the passive space, in a similar way, in the passive portfolio, you buy the index fund, then you want to have technology fund, you want to have EV fund. I mean, is that double doing the effort of the index?
Yeah, I completely agree. I think it's having a bouquet or having special products for each of these themes is great, but it just confuses the investor even more. And if anything, in fact, it makes investing that much more difficult because too many choices, then there is the choice paralysis, you don't know what to choose. Plus, then they will try and time the market. Okay, can I invest now? Should I exit now? In fact, with just COVID, when last 1.5 years, investors wanted to invest in pharma fund post COVID. So we had investors wanting to invest, say, last September, last October, and by then stocks had already run up quite a bit. And they wanted to sort of move out funds from their core portfolio, which is active or passive, to some of these thematic or sectoral funds. I think keep your core portfolio, your whether it's active or passive, as your diversified funds. And some of these sectoral or thematic funds could be your satellite portfolios. As long as the investor has this clarity, that's fine. But otherwise, we'll just end up confusing the investor even more.
Abhilash, would you say that passive funds are only for the risk-averse investor?
Sumera, not at all. I don't think so. When you are investing in equities, risk is inherent, right? Risk is always there. So from that standpoint, these are great products for investors, but definitely not for risk averse. I mean, risk is a factor of an individual's preference when it comes to what their risk appetite is, and every portfolio should consist of different categories of products based on the individual's risk appetite and risk preferences. If the user is younger, then they should have potentially could have more of equities and less of debt and other products. Whereas when the user is older, they should be looking at less of equities and more of debt and other products. So that's how we look at the whole risk aspect, and investing in passives, especially in equity passives, is as risky, if not more, as investing in any other equity funds. Just that you are investing in a diversified portfolio at a lesser cost.
Shweta, talking about building a portfolio. Now, if somebody was to build a portfolio, right? Since we've established that active passive mix is going to stay for at least a while in India, how does a person do that? What are the kind of active funds they would choose? How do they complement it with passive? Is there a certain market cap where being an active or passive works better? And how does the whole asset allocation work with this active passive combine?
Yeah, so Sumaira, I think when it comes to active and passive, what we usually recommend is that when investors are starting off, start off with passive and maybe large cap passive like a Nifty 50, so that you are exposed to some of the large cap stocks and you have relatively low volatility. So starting off with that, and combine it with mid and small cap actively managed funds, because we see alpha created there. So have a combination of these. Of course, there is tax saving that also comes in when it comes to retail investors. So I think that a combination of these 3-4 kind of schemes helps. For me, then the gold ETF is a good option to sort of pitch in along with some of these equity. So they get started off in the right way, and they tend to have more confidence as well.
Okay, that's a nice thought, Shweta. And incidentally, gold ETFs used to be the only, rather, they were the first ETFs in India, and the only option for a long time. But now the share of gold ETFs has shrunk. But this is a good way for somebody who's anyway looking to buy gold. Why not paper gold? Abhilash, what are some of the doubts that investors might have expressed? Are there any sort of lingering worries about passive products?
Sumaira, so when it comes to questions or doubts from investors, the first thing that they ask about, the investors who are slightly more aware, they ask about what is a tracking error and how much of an impact does it have on my investments. So our answer to that is tracking error essentially is how effectively the particular fund matches the returns or replicates the returns of the underlying index. And lower the tracking error, the better it is. And tracking error happens because of multiple reasons. There are reasons that includes liquidity, the ability of the fund house to buy the different underlying stocks based on the changes in the index, etc. And by and large, we recommend core and satellite portfolio model similar to what Shweta just mentioned. And core tends to be or should be your long-term portfolio, things that you'll hold on for the long term. Typically, it is best to have passive funds in your core portfolio, along with some bit of gold ETFs, to ensure that there is a hedge against any downturn that there might be. And in your satellite portfolio, one could always have small cap, direct equities, and even thematic and sectoral funds, or any new innovations that is coming into the market. And that's typically how we look at these particular doubts that investors have.
Okay. Shweta, what is your experience with the kind of apprehensions, if any, that investors might be expressing, and how are you addressing them?
So, Sumaya, like I mentioned earlier, I have to sort of provide more data when we are recommending actively managed funds versus, say, passively managed funds. I think some of the questions that come are more on smart beta funds. If you are just recommending plain vanilla ETFs or plain vanilla passively managed funds tracking an index, the questions are more on why aren't we doing smart beta funds, or how is this a better strategy, whether it's equally weighted funds or quant funds, saying, okay, is this going to be giving me better risk return ratio, because here the cost is also lower when it compares to actively managed funds. So those are the kind of questions we get. Of course, it is for us, the fund pedigree is one, the kind of tracking error, tracking performance that has been there, that you can check and track how well the disclosures are, how frequently they're disclosing the portfolios, and the tracking errors are lower. So those are the factors that we consider when we're recommending these funds.
Abhilash, since we've spoken so much about tracking errors, and even if somebody like me were to try and Google, there is only a limited amount of information available, right? So, how should an investor look at a number and say, this is palatable?
Yeah, I mean, Sumaira, tracking error is a very misunderstood concept. So there are two different things: tracking error and tracking difference. Tracking error is essentially how much of a difference does your funds returns have vis-a-vis the underlying indexes returns. If a tracking error of 1% could mean either that the fund is doing worse than the actual underlying index, or it probably could also mean that it does slightly better than the actual underlying index. So tracking difference essentially tells you whether it is doing worse or better. But see, what is the underlying premise or the purpose of an index fund or an ETF? It is to match the index. It is not to create an alpha over the index. So from that standpoint, what we say is, as close, the lower the tracking error, the better. It is not does not essentially mean that just because the fund overperforms, it doesn't mean it is better, because it is not intended, right? So if the same thing could happen on the other side as well. But the bottom line is this: lower the tracking error, the better, right? As long as the fund exactly as close as possible mimics the underlying index, it is better for the investor, because the underlying premise of a passive fund is not to generate an alpha, but to replicate the returns of the underlying index.
Okay, now let's talk about the taxation angle, because that's the other worry that a lot of investors have. Shweta, what is the incidence of tax on passive products, and between ETFs and index funds, which is more tax efficient?
So ETFs are taxed according to their underlying securities. So if it's stocks, it's a similar taxation as stocks, as equity, and if it's gold, it's taxed according to the gold, how it is. So for example, equity, it's short term up to 1 year, so 15%, and if it's long term more than 1 year, so that is up to 1 lakh, it will not be taxed. And similar is for passive funds as well. In terms of gold ETFs or other fixed income investments, passive funds and ETFs, The incidence is similar to debt funds, so up to 3 years is short term, it's added to the person's income, and beyond 3 years is when it makes a slightly better sense, so 20% after indexation. In terms of taxation wise, I think ETFs work out a little better than passively managed mutual funds for this exact reason.
Okay, Abhilash, we've spoken about passive funds for beginning, for investors who are just sort of, starting out or beginning. How would passive products be for, say, people who are close to retirement, right? Or, the 50 plus? Because while the upside is that, you will get market linked returns, the downside is that, if in case there is a drawdown, you also get the full effect of that drawdown. So, do you think they need to sort of start moving out of passive products if you're closer to your retirement? I mean, is it the same thesis as an active fund that you sort of taper off your exposure?
Absolutely, Sumaira. So, the from a portfolio standpoint, it remains the same, right? The closer you are to retirement, the lesser should be your exposure to equities, because equities tend to be volatile in the short term. So there is no difference, at how you look at passives. But like I said, within passives, there are debt passives as well. There are, gold funds, silver funds. You know, the allocation or exposure towards equities, be it in active funds or passive funds, should be a function of what the individual investors' goals are. If retirement is the goal, there should be a progressively lesser exposure towards equities closer to the retirement age, and that's how we look at it.
Okay, that's a fair point. Equity is equity. Shweta, would you agree that, taper off passive exposure as you would your active equity exposure if somebody was, say, closer to retirement or to the completion of their goals?
So I think other than the next 3 to 5 years cash flow that you can keep in sort of safe funds or FDs and bank as a combination, you have to make sure that you're invested in equities because you have to stay for the next 2 to 3 decades in your retirement, and you have to make sure that this money grows. And having 2 to 3 decades to grow is actually a great time to stay invested, right? So I recommend people who are looking at retirement, close to retirement in their 50s and their 60s, to stay invested in equities other than the next 3 to 5 to even maybe 7 years, because otherwise people tend to spend a lot of money upfront without providing for the next couple of decades, right? So because you're seeing there's a lot of money, you're seeing that there's a lot of time, so that kind of plays on you. So where you would spend earlier, say a lakh or two, you end up spending 5 to 10 lakhs. So the difference is actually huge. So I actually want people who are close to retirement to stay invested in equities and not touch that. I see more and more people who are retiring or just retired take out money from their investments and actually gamble that away. And I'm using the word gamble not loosely, because then they are creating their own direct equity portfolios and trading and day trading because they have there's so much time on their hands, right? And without doing enough research, and then they tend to panic when markets fall or correct, which they will. Just because the last 1.5 years has been the way it is, it doesn't mean the next few years are going to be similar. So I want people who are looking at retirement and are just retired to stay invested in equities because there is a long a time that they can stay invested. Of course, asset allocation, you have to keep correcting. So they can rebalance their assets every year, which means that you see the next 5 years every year. So making sure that they don't lose sleep over it, right? That you have to make sure that you eat well in your retirement and also sleep well. So that combination has to be correct, which is why I say 5 to 7 years cash flow. They make sure that it's safe, and beyond that, has to grow, because inflation is not going to retire just because they have retired.
Yeah, no, no, absolutely. A couple of points actually come to mind from here. One is, of course, that the fear that you may outlive your savings is very, very real. In fact, I've spoken to a lot of insurance companies, and they're very worried about this aspect as well. The second is that there is a safe withdrawal rate, right, which you can use to withdraw money from your retirement. You don't go all out. And the third aspect being that, one is you have to take a call for yourself whether you have enough and therefore you can taper off, or you don't have enough, you want to stay invested. And certainly the money that needs to be passed on to the next generation, let it be invested according to their risk appetite. But anyway, let's not digress into retirement. Let's keep the focus on passive investing. Abhilash, is is passive investing a good enough product by itself, or has all the growth that we have seen so far in India only driven by the underperformance of active funds?
Yeah, so interesting point that you raised there, Sumaira. So a lot of investors out there are first-time investors, and they don't essentially have the luxury of going to a fund manager or a financial advisor, or they don't have the access to such systems. Now, for them, going out and picking a fund, picking a stock is very, very, very difficult. The cognitive load associated almost puts them off, right? So if we need to see more and more active participation from the retail investors in the markets. Passives are a great way to do that, and the performance of passive products over the last 5-10 years have been by and large, especially in the large cap category, much better than the actively traded funds. So passives are great products, especially so for first time investors and long-term investors. Absolutely no doubt about it.
Okay, Shweta, I don't know of any retail investor who has actually compared the returns of their fund between active and passive, right? So I haven't heard of anyone saying, I have this active, say whatever large cap fund, and guess what? They look at it in absolute terms. Not very many investors are looking at it by comparing it, maybe to the benchmark, yes, but certainly not to whether alpha has been created or not. So therefore, does that argument hold that passive products are doing well because active products aren't?
I think they may not be comparing within their own portfolio, but we're all reading, right? So when they're reading, saying active fund managers or large cap active fund managers aren't performing and they're still charging a fee, which is high, I think it hits home more than they're seeing it in their portfolios. So in their portfolios, they may not know what is doing well, and if we are seeing it grow, it has to be in the last 4 years it's not grown twice, it has grown multiple times, right? It has grown from say 35,000 crores to about 3 lakh crores today, and we are seeing that it's about 10% to 12% of the fund industry today. And if you're seeing this till by 2025, I'm told that the estimate could be about 35 to 40% of the industry. So this is definitely an area that is generating a lot of interest actively. So passive funds are here to stay.
Yeah, absolutely. And just one final question, Abhilash, is that globally we have seen very interesting trends. Okay, one that caught my eye recently was that a couple of funds are actually looking to convert their actively managed funds into passively managed products. Right? I mean, JP Morgan amongst them is moving, or rather, they have sought approval to move 4 actively managed funds into being passive funds, right? That's a total over $10 billion. Add to it the other 3-4, AMCs which are considering it. It's a sizable kitty, but of course, a fraction of the passive market in the US. Do you see, a lot of similarities between India and the West in the way there has been this acceptance of passive products? I mean, do you see the Indian market also at one point evolving to the way we are seeing acceptance for passive products in the US. I mean, you also have innovation not just in funds, but you have things like ETF wrappers, etc., which is a basket of ETFs available. What can we expect, in India going ahead?
Absolutely, Sumera. So I think by and large, the trends or the reasons why passives have gained widespread acceptance are similar to what happened in the US when you compare it with what happened in India. Underperformance of active funds, cost, and regulatory aspects, right? And similar trends we are seeing in India as well. Underperformance of active funds is there. Cost aspect is one of the critical reasons why investors flock towards passives, and a lot of regulatory and government initiatives. Like in 2015, there was this whole disinvestment drive through ETFs that created a lot of interest when it comes to retail investors investing in some of these ETFs that were launched. Similarly, EPFO invested a huge sums, and continued to invest huge sums into ETFs. So all of this have contributed to the rise of passives. And if you compare the sizes of assets under management in the US, today in the US it's about 37%, and like Shweta and you mentioned, in India we are at about 11%, 11.4% as of October 2021. The interesting thing is, this percentage, a percentage of assets in passive funds, as compared to the overall assets under management in the mutual fund industry, used to be about 1% a decade back, and that is 11% now, and that is a compounded annual growth rate of about 62% over the last one decade. And while the overall mutual fund industry has grown at a rate of 18% over the last decade, we don't expect a growth rate of any less. In fact, at Finity, we recently launched a report, a passive investing report, and our prediction is that by 2025, our total assets under management in passives would be about 25 trillion rupees, which is about 37% of the overall assets under management in the industry. So these are very, very interesting and exciting times, and I think passives is definitely a movement and a wave, and we are very excited about it, purely because passives are great products for a vast majority of investors out there. Passives are simple and easy to understand. These days, a lot of funds are pushed towards investors through advertisements and things like that, and passives tend to be one such product which is for if you consider all the other different categories, a passive index fund is the easiest product to understand for a first time investor. So these are great products, and we expect that the growth momentum will continue and improve as we go forward.
No, absolutely. While passives may not be the only product choice for investors in India right now, there's certainly one of the choices which investors cannot afford to ignore. Thank you very much, Abhilash and Shweta, for joining in and for talking about passive products in India. Certainly something which is seeing a snowball effect, and it's only going to get bigger with time. So for everybody who's watching, I hope you enjoyed it. I hope it was informational and that you learned something new. So thank you very, very much for watching. Stay safe.